Welcome to this edition of Tiger Trade Weekly for Friday the 15th of March. My name is Greg Boland of Tiger Brokers, and each week we will review what has happened in the US share market and what to expect in the coming week. Last week the S&P 500 fell 4 of the 5 days and closed down only 0.3% for the week. Interestingly, this is only the third down week since October last year. So we've had this stellar bull run since October, and this is the third down week. Before this, the market had increased 16 of the past 18 weeks, something it hasn't done since 1971. Last Friday, the S&P 500 hit a new intraday all-time high of 51.89 before an aggressive sell-off later in the session after the February non-farm payrolls report showed that 275,000 new jobs were added versus only 200,000 expected. Albeit that the unemployment rate moved up from 3.7 to 3.9%. It was also notable that the two previous months were revised down by a total of 167,000 jobs. The chart shows the monthly job creation numbers from the US Bureau of Labor Statistics. The highlight of the US economic numbers this current week has been the CPI number, Consumer Price Index, for February, which came out on Tuesday, US time. After a hotter than expected release in January, markets were bracing for evidence of persistent inflation pressures. The headline CPI number was 0.4%, in line with forecasts, but is the highest since September, while the core CPI was also 0.4 versus 0.3 expected for the month, so slightly higher than what people expected. The annual inflation rate came in at 3.2%, again slightly higher than the 3.1% expected, and the core inflation rate was 3.8, again higher than the 3.7 expected. But this is still the lowest since April 2021, when inflation started to rear its ugly head. This was the last economic release ahead of the Federal Reserve meeting next week. While markets don't expect any change in interest rates next week, the CME FedWatch tool current pricing implies only a 7% chance of a cut in May, so no cut in March. The next meeting is in early May, and before the economic numbers came out, the inflation rate came out, there was a 25% probability of them cutting rates in May. That has dropped to 7% because inflation and the job numbers were higher than expected. The job and inflation numbers, along with major players stressing that the Fed should tread carefully before cutting rates, have changed these expectations downwards. For example, Citadel's founder and CEO Ken Griffiths, who was speaking at the FIA, or Futures Industry Association's annual conference in Boca Raton in Florida, stated that the Fed shouldn't cut too quickly, citing big tailwinds supporting inflation. What he's saying is that if they cut too early, he doesn't want the rates to go back up, so you better to wait and then cut rates when the Fed is comfortable to do so. The chart shows that the market is now expecting a 25 basis point cut, or 0.25% interest rate cut, in June, September and December, with no cuts in the intervening sessions. So this is in line with the Fed's prediction earlier in the year that there'd be 3 rate cuts this year, and the market is finally coming into line with what the Fed predicted. Earlier, people thought there would be 7 rate cuts this year. Now the market is in line with the Fed, saying that there may be 3 rate cuts this year. In terms of the actual market this week in the S&P 500, it was higher both on Monday and Tuesday, but then lower on Wednesday and Thursday, ahead of what is called the triple witching hour, which is on Friday. Triple witching, or often sometimes called quadruple witching, as it's sometimes referred to now, is the third Friday of March, June, September, December. And this is when the stock options, the options on the index and futures, as well as their associated options on futures. So 4 things: stock options, options on the index, futures, and futures options on the futures contracts all expire at the same time. Time will tell if this bull run is running out of steam, and these headwinds with inflation has definitely stymied the market over the last week or so. In individual stock news, semiconductor stocks have been down 7.3% for the week, with tech darling for this year, Nvidia, down 5%. Interesting, Nvidia is still up 78% year to date, and we're not even halfway through the 3rd month. Tesla is down 35% year to date, with Chinese EV maker BYD taking over Tesla's EV dominance. As per the chart, the global BEV market share for 2023 was 20% Tesla and 17% BYD, and that is now changed so that BYD is ahead of Tesla in numbers for 2024 to date. Amongst other markets, the precious gold market, the precious metals market in gold, it's had a huge run with the gold or GLT ETF doubling in price between 2015 until now. Again, time will tell whether gold is also topping out in line with the S&P 500. So thanks for joining us, and we look forward to seeing you again next week after the Fed meeting on Thursday morning, New Zealand Daylight Time. Thank you.